Hi, welcome to Wealth Management Forward, the program that teaches accounting firms how to implement wealth management services. I'm your host, Rory Henry, Director of Business Development at Arrowroot Family Office. I have the pleasure of being joined by Ross McGoodwin of DPL Financial Partners. Ross, how you doing today?
Doing very well. Rory, thanks for having me. Excited to get the chance to work with some of your advisors and see how we can enhance their planning opportunities.
Great. So Ross, you know what? I've talked about you guys, extensively in a number of our different episodes, and I just love the solution that you guys have come up with. I always got the feeling that whenever you heard life insurance or life insurance agent, that just didn't sit well with you. It always goes back to that movie Groundhog Day with Ned Ryerson, and he walks up to Phil Connors and tries to sell him insurance.
Hey, Phil? Phil Connors? Phil Connors, I thought that was you.
Hi, how you doing? Thanks for watching.
Hey, I sell insurance.
What a shock.
Do you have life insurance? Because if you do, you could always use a little more. Am I right or am I right or am I right? Right.
The feeling I got when I heard life insurance, and you guys have kind of solved that life insurance agent issue, and you're gonna let our audience know, what you've done as far as tackling this problem and the Ned Ryersons of the world.
Yeah, absolutely. It's been an area of planning that has, I think, been a conundrum for a lot of advisors for a long time. You have insurance agents and insurance people that try to solve everything with insurance. And then you have a lot of times investment advisors who just try to solve everything with investment advice and investments alone. So it's really interesting now that there's finally an intersection that we hope we've created where advisors can really try to piece together the whole financial plan within a fiduciary business model. So we're trying to bridge that gap between insurance carriers and advisors. For a long time, it's been so commission driven with insurance annuities, and it's just needed an overhaul. So that's where we come in.
Great. Yeah. I mean, look, this goes into our whole holistic wealth management model and the essence of our program. And this why you guys being this platform and offering these commission-free solutions fits into our model perfectly. So, I want to dive in here and do this joint webinar and have you explain a little bit about the DPL platform, what you guys are offering as far as a solution, go into, commission-free insurance as well as your no-cost evaluations. Okay.
Absolutely. Yeah.
All right. Why don't you go ahead and share the screen, Ross, and let's get started.
All right. So definitely really excited to be working with Arrowroot advisors. And I know you all have a great program in place for advisors to try to have really smart wealth management solutions and strategies that will enhance their practice, but be able to give them, competitive edge at the end of the day versus other professionals out there. So really the point of today is to introduce our platform, our services, how we can help advisors be able to get started at no additional cost to them. And ultimately, we're all about better serving clients. That's why we're all here today, is to figure out how we can provide better value.
Great.
So really just what we want to do from a big picture standpoint is talk about the changing industry. There's a lot of new solutions, new perspectives as to how these end products can be implemented in the plan. So everything that I think a lot of advisors have in their minds about insurance, a lot has changed. And it's not just the solutions themselves, but the distribution of them and the motivations that I think are really important that needed an overhaul. So we'll talk about the difference with the commission-based agent model now versus the fiduciary model. Of course, what does the repricing look like to clients? How can these solutions be repurposed to then better serve the end consumer? Talk briefly about what the landscape looks like today with these carriers that really needed to have a better format to access advisors and that fee-only space. And then we'll talk a little bit just quickly about the current landscape, specifically with retirement income. It's an area that I think a lot of advisors think is of high priority right now. You have clients living longer than ever, rates at historic lows. So now there are solutions that have been built to really help provide more efficient income in retirement. Guaranteed income is inherently a good thing. The problem's been that sometimes it wasn't really presented in a fiduciary manner, right? You had clients who didn't need it buying it or didn't understand it. So look forward to just quickly diving into that landscape and how now advisors don't have to shy away from it if it is something that's good for their clients, because now it can fit their business model too. And then we'll give you a quick use case scenario of how that comparison plays out for the end consumer.
Okay, Ross, let's talk about the difference between the historical life insurance agent who receives commission and now this commission-free model, which is under a fiduciary standard that's offered by an RIA.
Yeah, absolutely. So there's been a big shift now where, historically, the life insurance agent has been the one who has to execute everything, and they just frankly work under different.
Great, Ross. And let's talk about the difference between the historical life insurance agent who receives commission under a suitability standard and a broker dealer, and that now a commission-free solution that's under a fiduciary standard and the RIA model.
Yeah, absolutely. So there's been always, I think, a butting heads of business models, but also just really a standard for review and implementation on both the broker dealer side and the RIA side. The broker dealer just has a suitability standard where, as long as the solution that they're putting in place meets a minor suitability criteria, they can ultimately be able to place it. The RIA, they hold themselves to a higher standard, and it's about the fiduciary standard, meaning they're putting the client's interests above their own. They typically are going to take more of the context of the whole financial plan. And I think that's a big difference at the end of the day. The problem, though, is that the RIA might work within that standard, but then they have to send it out to that broker dealer or insurance agent to execute their recommendation. So it's a bit of a convoluted process. Mm-hmm. So if you look historically, as I just mentioned, insurance agents with that commission-based model, there's less steps of review and ultimately making sure it's the right fit. So just as a quick example, an insurance agent might be working with a client that typically maybe they just need term. They don't really need something to really provide long-term estate planning or tax advantages with permanent life insurance. But maybe that higher commission and earning opportunity for them leads them to recommend a product that is maybe not in the client's best interest. That's the difference in approach with an RIA that's going to take more of a planning first model and figure out, what do I need to solve this problem with my client? If it's just term will be recommended, and that might be more efficiently priced for the client. Whereas the insurance agent, because they don't have maybe the full context of the plan, or maybe they're incentivized a little differently, they might recommend something that's not as good of a fit for the end client.
Right. So that could be best aligned, whereas this RA model under a fiduciary standard is more in line with the client's best interest, because you're able to take a holistic approach for the client.
Absolutely. Taking all that context into play is really important, but then now giving the RA a little more control over that implementation, I think is key, because sometimes they send it out to the agent and they're just crossing their fingers, hoping everything gets executed the way they wanted, or the right product is executed. There's a little bit of loss of control of client experience and implementation.
Right.
That happens. So with the commission-free and fiduciary standard, this, as you just alluded to, it's going to be customized every time. So it's not starting with an idea of a product or an investment amount. That's more of a sales-driven model. Right. Instead, it should be, what problem are we solving? Do you need income replacement for a 20-year period? That's what term's built for. Or if it's more about a high net worth client trying to evaluate their estate planning needs, and they have a real interest in creating a real tax efficient legacy planning tool, then maybe permanent life insurance makes a ton of sense. But it's more about arriving at, what's our problem? How can we solve it? Instead of starting with the mindset of a product or the highest commission up front. That doesn't lead to the best incentives typically.
Right. That's great. Makes absolute sense.
Yeah. And then furthermore, with this approach, you're also, in a lot of cases, going to be access to a commission-free solution. That means that there's less compensation built in for a commission distribution, meaning more value is going to be put in the product for the end client's benefit. So that's definitely a win-win, better experience for client, but maybe more efficient product as well.
Great. All right. And then, why didn't advisors help with this, in the past? And then how has DPL streamlined the process?
Yeah, so I think this picture is funny because it really does I think paint the picture for how a lot of advisors feel when the word insurance or annuities come up. It means they have maybe more work to do that they're not going to get paid for, or that's just not their area of expertise. But if you're a holistic planner, you absolutely have to be addressing these areas, especially now that it's available to your business model. If you're a holistic planner, uh, insurance, guaranteed income, are things that are going to affect the financial plan. The problem, though, is that it was a headache to figure out, well, how do we get implemented? What are the best solutions? I maybe not licensed, so how do I ultimately get this into place? It brings up a lot of questions about how that can actually get into the client's financial plan. So that's where DPL comes in. We are not an insurance carrier, but we work with about 20 different insurance carriers to get access to the RA space. So what we do is we help you access all of these different carriers and in solutions with one point of contact. So how does this really speed up the process or make it a lot more simplistic for the advisor? Well, we're one point of contact from the beginning with case design and analysis. So if the client has an existing policy, we'll take a look. We'll see if there's maybe something better in the industry that can solve what you say is their goal. Or you might have a client who has a clear need of insurance or guaranteed income in the plan. We can take a look at that and the details you provide and really provide, a prescription, if you will, to solve that need.
Great. And some of your stats, Ross, I know we talked about it before on these evaluations. What percentage roughly of these policies are being rewritten, due to the high commission usually banked in?
Yeah, it's a great question. So when we do our proactive analysis, which of course we provide for firms at no additional cost to them, I would say it's usually between 60-70% of the time we
Wow.
can improve the outcome. Yeah, so I think that really surprises people because they assume a lot of times those assets are allocated. They're never going to move. There's no
Yeah.
way to improve them. Well, now that this restructuring's occurred, it might surprise you. The commission-free policies in the permanent life space, they might be 30% lower cost for the same death benefit goal. The annuities might have 80-90% less distribution cost that then leads to lower fees or more flexibility. So it's worth taking a look because there's a lot of situations we come across that advisors assumed they couldn't improve, and it actually made perfect sense to make a change. So this restructuring is very dramatic and will certainly benefit the client in most situations.
Yeah, and going over the paperwork and submitting some of these policies for review. Can you touch on, the simplicity of the paperwork and what's needed by the advisor and from the client?
Yeah, certainly. So it's great. Okay, we figure out what we want to do, but what are the next steps? That typically is going to bog down advisors. Well, since DPL has a whole team of consultants that are licensed agents, we're the ones who are really handling the bulk of the process entirely. So all we really need is some upfront information about the client, and then our operations team will actually go through and pre-fill all the paperwork that is required. So you're not just getting a blank application on your desk or sending that to the client for them to figure out. Our team pre-fills everything, and then we're really going to quarterback the whole process. Furthermore, we'll make sure that the advisor also is included on the policy as a financial advisor to be able to get access to everything that they need from a servicing standpoint. But to that point, on the back end, in terms of making sure things are going well, getting access to forms and everything, there's really no need to ever contact the carrier directly. You contact your consultant at DPL, and we'll be able to get everything taken care of for you and make that a very simple step.
Great. All right. Yeah, and then I think the next question I put on here is how can advisors leverage this solution and start charging for these services?
Yeah, absolutely. We know everyone here is running a business, so you want to do what's right by the client, but you're also probably interested. Well, how can this? Because it's commission free. How can this fit into my practice? Well, it's a great question. After this restructuring has occurred on really any policy with a cash value, think of it as something that can now be part of your assets under management. That's the truth. Because there's no commission, that opens up that door of opportunity. And people sometimes ask, "Oh, are advisors charging their full management fee, or are they going to charge, a certain percent, 1% or so. What we say is, well, first, it's commission free. So it's entirely up to you. There's usually maybe a limit of how much you can charge, up to like 1.5%. But there's no requirement to charge anything, and you can customize it as much as you want. But what we do implore advisors to think about is that don't discount your services. If you're certainly helping out the client, you should figure out what you're comfortable with at the end of the day and make sure it's included into that equation. But furthermore, if there's a solution that doesn't have a cash value, a lot of advisors may charge for their time or charge a financial planning fee. They'll figure out how that can fit in. But because this can now be part of your fee-only model, there's actually maybe a really large untapped opportunity within your practice. You'll see the stat there on the right. $1 in $6 of savings are, the stats show, and this is from LIMRA, are in cash value life insurance and annuities. So that's about 16% of savings could be out there that are not being managed by a fiduciary. And through the help of someone like us at DPL, we can proactively help you capture that potentially within your practice as well. So,
right. And I see that point here that below that is, and I know it's the question that people are going to ask is for at least our accounting firms that are watching this is, do I need to be licensed as an insurance agent to start offering these solutions?
Yeah, great question. Through our model, you actually do not need to be insurance licensed or have a broker-dealer relationship where that's necessary on a policy. So we handle all the licensing. You actually do not need to have that. Now, if you already have your insurance license and you want to keep it, hey, feel free. We're not telling you to drop it immediately. It is up to you ultimately. But with the model that we've built here, we make it so that you have us handle the licensing, the appointment, product training, things like that when that's required. You're just on the policy as an RIA, as the fiduciary to manage it at the end of the day. So certainly should make things a little easier for you to implement ultimately.
Great.
And then just one other thing that we like to point out here too is that there might be interest in rethinking areas to the portfolio, such as fixed income and guaranteed income. Those are things now that don't have to leave your business model if it would benefit your clients. So that's another thing, is that we even have firms telling us that they at times recommend or have clients going to things that are like CDs or annuities, and they just assume that's a loss of revenue or assets. Now these commission-free solutions are better, they're repriced, and you can keep and retain that relationship and that asset within your business model. So that's why today we just want to really make sure advisors think about taking a fresh look at all these things within the financial plan.
Absolutely.
And one last point here, think about your approach to helping clients. You now can tell them, not only do I have a fiduciary minded approach with investment management, but we can extend that now to insurance, annuities, and everything else that might come up in the plan.
Okay, great, Ross. That makes total sense. Let's talk about how are these solutions being used now as a retirement vehicle? I think of interest rates and where they're at. Can you touch on how people are using this as far as retirement income?
Yeah, certainly. So right now, it's a really interesting point in time where clients are getting older in terms of the population's getting older. More and more baby boomers are retiring. And you also have the joint effect of interest rates at historic lows. So what that means is that a lot of people have built their practice around historical assumptions. So maybe like a historical 4% safe withdrawal rate. Well, that's based off historical averages on interest rates. When you're at historically low interest rates, that might be too aggressive of a withdrawal rate to feel safe in the portfolio. So it's a great point in time to see, well, where do annuities maybe help with this whole equation, or maybe add more security to my financial plan? And some advisors will say, well, aren't the annuities also addressing this interest rate risk and maybe changing what they can pay? Yes, of course, they're also making adjustments. However, the academics say that when you have lower yield, the value of lifetime income or mortality credits is actually heightened. So what I mean by that is, when you are creating a lifetime income stream, that means that that asset in the annuity has an income stream that will be paid out even when the account value reaches zero. That's something you can't replicate with investments alone. So in low interest rates, that value is actually heightened. That means that you can get a higher withdrawal rate, perhaps, off that same investment, which then creates more stability for the client to rely on that during retirement, and then maybe even helps you as an advisor invest more in equities or kind of the long-term legacy planning part of the financial plan. So that's what advisors are evaluating right now. Can we perhaps be more efficient to create income if we add more guaranteed sources into the financial plan? I think it's really interesting here talking about pensions disappearing. Clients love pensions. Pensions is another annuity.
Yeah.
The problem is that pensions are going away though. So you can essentially now offer up a pension type replacement within the plan to create more guaranteed sources to meet essential expenses or enough expenses to maintain their lifestyle. The expenses that will not be as consistent, that will fluctuate, there are other income strategies that might be better suited for that. But you'll be really surprised about the client satisfaction and also the efficiency of the plan when you have more guaranteed sources, meaning Social Security plus pension, if there is one, plus annuity to meet those necessary expenses in retirement and not have to worry about market risk or interest rate risk, maybe really affecting that spending potential for the long term.
Great. Makes total sense. And Warren Buffett even says here, bonds are not the place to be. And then fixed income investors, pensions are suffering a bleak future. So, this is another viable option with these commission-free solutions that is more enticing for advisors to be able to offer their clients.
Absolutely. And that's why it's worth taking a fresh look. They've been repriced, so they're more efficient than they've ever been.
Yep.
And I think there's also a misconception that, okay, if I introduce an annuity, it's an irreversible decision. They just think annuitization. Actually, a lot of times we're talking about flexible strategies where you maintain control of your cash value, you stay invested, and you still get the benefit of lifetime income. So it's a perfect chance to really evaluate the bond portfolio or the overall portfolio and see, does it make sense to add an annuity to a part of the plan? Now that it is accessible to me, I don't have to shy away from this if it does in fact look like it'd be beneficial for my client.
Right. All right, now let's talk about the carriers and what carriers do you guys work with, and how does that process unfold?
Yeah, absolutely. So we, of course, have been the ones, since 2014, since our CEO, David Lau, built up our platform. We've been really talking with carriers about this opportunity to work with RIAs. And thankfully, landscape's changed a lot. We've gone from just a couple carriers, couple solutions to now there's a whole menu of options that are available, which is great. So it wasn't just educating RIAs, it's also been educating the carriers. And that includes how to reprice a solution. It also means how to access an advisor directly. So that means how to work with someone like DPL to handle licensing, but from a technology standpoint, how to give you proper login capabilities, proper management capabilities to support your business models. So anything that requires your management, there is a big piece that needed to be figured out in terms of access. We help them on that and also make sure that they can get that asset to report to your portfolio management software and the different systems that you're used to using on a day-to-day basis. So our role in the industry is to really be the intermediary between both RIAs and insurance carriers. We provide consulting for both at the end of the day. And we even create products oftentimes with carriers directly to help them reach you.
Wow, that's great. And what carriers are you guys, currently working with here? Oh, we have this in this slide here.
Yeah. So here's a quick snapshot here. So these aren't, B-rated carriers or, carriers you've never heard of. These are large players in the industry that have realized they've really lagged behind the fiduciary RA model. So that's where we come in to, of course, give you access to them, but make sure that they're meeting your standards as a fiduciary. So you'll see top, really large carriers like, Allianz, Equitable, Jackson. Jackson's the largest annuity provider in the space. Allianz, one of the largest in the fixed space. So you're getting the best in breed by what you're looking for. And that's what makes it a more efficient picture. A lot of advisors, if they're building an investment management portfolio, and let's assume they're using mutual funds, usually you're not just going to use one strategy or one name. You're going to diversify, and we're doing the same thing in terms of bringing the best in class to solve for each category at the end of the day that we need to be able to help you as a financial planner.
All right, great, Ross. And now let's touch on, commission versus commission-free examples, so we can give our audience a look at, the advantages of commission-free solutions.
Yeah, absolutely. So when you're looking at the comparison of commission versus commission-free, it's important to understand, what changes, and it's not always going to manifest itself in the same way. What I mean is, different solutions are going to have different levers that are going to be affected with their removal of commission. You can expect typically lower costs, but it could also mean maybe enhanced benefits or more flexibility for the end client. So the first example here today that we're going to look at is a situation that's very common. A client owns an existing annuity, and it's a variable annuity, and was sold to them 10, 12 years ago. Mm-hmm. And they're not really sure how to maximize it in the plan. It's commission based, and it's now out of surrender. And what they're after is maximizing lifetime income. But they'd also love to cut costs if possible. That might sound like it's a tough combination, but it is possible. And part of the approach here at DPL is that we're also not incentivized by one product type or carrier. It's finding the best solution, again, that fiduciary implementation that you would expect to meet the exact need for the client and the financial plan. So this solution right here, we evaluated that the total costs were 2.78%. So getting close to 3%, that of course hurt their accumulation value. We're able to bring a product to the space that was going to dramatically reduce fees. We're talking a savings of 2.28%, because this solution on our side only was going to cost 50 basis points. So that was going to help really draw down on the explicit fees and create a very simplistic picture of what they're paying for. So that's what to expect a lot of times from a cost perspective, is that there's a huge opportunity typically to lower costs, because we're lowering the distribution expense usually by 80 or 90% at the end of the day.
Wow. And that translates into the benefit analysis here.
Absolutely. So now the reason we're in this situation was to look at, well, how can we maximize lifetime income? And the current solution, they assumed that maybe it wasn't going to be able to be improved. They had a 5% lifetime payout rate. I just said earlier that the 4% withdrawal rate's maybe too aggressive on investment alone. So you look at 5%, you're like, oh, that's probably pretty strong. It is maybe compared to a lot of traditional strategies. However, there was a chance to even improve on that within the DPL platform. The solution we brought to the space was going to be able to increase that payout rate by over 1.5%, up to 6.55% for life. So immediately the client was receiving a raise, if you will, on their lifetime income and able to get that benefit right away.
Great.
And then furthermore, you're also looking at better cumulative income. So not only was the starting income going to be better, but we listened to advisors and found out that the in solution really could benefit from a cost of living adjustment. So we were also able to build that into the mix at no additional cost. This solution has an inflation adjustment of 2% for life. So that was going to be a really important advancement for the end client.
Okay, great. And then it looks like the dollar figures here in year 1, 2, and 3 do start to accumulate and provide an increase in income.
Yeah, so we actually listened to advisors, and they were saying, better guaranteed income is great, but we'd also like to have options that can address spending power and inflation risk. So we customized this solution to also have a lifetime 2% cost of living adjustment. So not only is there better income right away in year 1, but it starts going up by 2% annually. And then you look at the first 3 years, and you now have even better cumulative income story to pass along to your client. And that was going to be precisely what was going to help them out in the long run. So from beginning to end, you'll see a solution specifically designed for what they needed.
Great. All right, great, Ross. That makes total sense. Look, I think the points that we want to get across in this joint webinar is, this commission-free solution with a no-cost evaluation really provides value to your clients. And it's something that you can take a look at, and you guys have streamlined the process to make it easy on the advisor to get these reprice solutions.
Yeah, at the end of the day, this is a new opportunity that, for, as I mentioned, for our clients and advisors, is untapped. So what you can do is leverage an RA like Arrowroot Family Office to be able to connect you with us and start evaluating where can we help your end clients. They likely own these solutions already, and they're certainly going to need to own them in the future as well. So
Right.
at any point in the process, there's likely a way that we can help you through Arrowroot to be able to make sure clients have the right solutions. There's maybe an opportunity to improve those solutions, and that you have a fiduciary implementation at the end of the day, which is what we're all about during our discussion.
Great, Ross. I appreciate you joining me today on this joint webinar. I'm excited for the future and what you guys are offering. We'll speak here shortly in the future.
Absolutely. Yeah. Look forward to it. Thank you for the time. Excited to get started with everyone. And certainly feel free to reach out to us and Arrowroot if you have any questions about this new landscape and how we can help your clients.
Great, Ross. You have a great day.
Yeah, thanks. Yeah, you too, Roy.
Thank you.